Well, the first thing I want you to understand is this is going to be like the very first baby step to understanding institutional order flow. The first thing you need is movement. You have to understand that to be a buyer, there has to be a willingness of somebody with bigger pockets than you, more money than you, and they're the ones that move price around, and they are the banks. Okay, they're only going to let price go higher when it suits their purpose. Okay, so it's not going to be a supply and demand factor. It's going to be a greed factor. They want money. Okay, they're in the business of making money. After all, that's their nature of their business. That's a bank. So if we are looking for buying opportunities, okay, many retail traders look for all of these patterns and indicator-based ideas, and I want you to focus primarily on price. Price alone will give you everything you'll ever need in terms of indicating higher or lower price, and it'll actually give you the actual specific entries and your exits. You don't need anything else outside of a price chart. Okay, the open, high, low, and close does everything for you. I want you to look at this low down here, and I want you to look at this high up here. Okay, do you see how that is the biggest price swing on this entire chart? So between August 14th all the way to the present time in September, there has only been one major price swing, higher and lower. So if we take a Fibonacci level, okay, and I'm only going to use Fibonacci to illustrate equilibrium, okay, because I first have to establish what equilibrium is. This is the largest price range, okay, or the market range that's presently being traded in. Now, what do I mean by present market range? This is the highest range we've seen, okay, in the last month or so. So if we look at this range, and I'm going to scroll back here so you can see it, there's nothing more significant than that except for this one back here, but we're going to primarily use this because it has a very strong reaction. We can use these back here, okay, and I'll do it for completeness sake later on in the video, but for now I want you to see we have a very strong impulsive move away. Then it comes back, retraces, then it have another strong impulsive move away and comes all the way up here to the high. Okay, when we say impulsive price move, or what will be referred to as impulsive price swing going forward throughout this mentorship, that is the indication that there has been displacement. Now, displacement is where someone with a lot of money, okay, comes into the marketplace and they have a strong conviction to move price higher. We already know that price is going to be set by the central bank. So if they're letting price run this high, they're offering at a higher price. As long as there's buyers coming in, they're going to keep offering that price there. As long as they keep finding buyers, as they keep raising price up, they'll keep expanding price higher, 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 until there is no longer any interest for them to pair up orders with participants, okay, other open interest in the marketplace. So they'll allow price to retrace a little bit until they can get more buy stops above the marketplace. It is not a buyer market and then keep stretching price. They have already bought down here, and then they're allowing price to be offered to the marketplace at higher prices. Okay, and as that happens, all they're doing is selling off their positions they established at a lower low. Okay, from here, the banks are in long positions in here. They accumulate long positions. Once they accumulate a position, they allow price to go higher. Okay, once that price goes higher, 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 it keeps going higher until their position is funded and they no longer want any more position held. So they're going to be looking for liquidation areas where they know that there's going to be willing participants to buy. That's going to be above this old high back here. Why would they want to take price above that old high here? Because there's going to be buy stops on a fund level. That means big money managed funds will have stop loss orders right above that high. And I'm going to go into details in this mentorship about where stops are, how to pick out institutional funds levels where their stops are at, where high target big money moves are going to occur. All those things will be taught to you, but for now I just want to start you very small, because then there's a lot of folks that just started with this mentorship and they've never really been through the complete library of my concepts, or they haven't really exposed themselves to technical analysis. So all this seems Greek to them. And I don't mean that to offend anybody that may be Greek, but it's an expression in the States. It means it's alien to them. But the first thing I want you to look for in price is you want to see impulsive price swings. Okay, and since we're primarily looking for discount markets, okay, in relative terms to equilibrium, we first have to understand what an impulse price swing is. So let me take the fib off real quick and go back to that price leg right here. Let me take all this stuff off over here. Okay, so we have one big strong impulsive price swing right here. It comes off this low and rallies up. We don't need to know what caused the buy down here. It's not interesting at all to me. I don't care. Okay, we don't know this price length is going to start until, we don't know this price leg is here, okay, until it forms. So I'm giving you a perspective. Studying in hindsight, the low to this high in here, okay, that rally up or that impulsive price swing, we only require price to start coming down off of that, and it takes at least 4 candles. No matter what time frame you're on, you need 4 candles, okay, from when the market makes a low and starts rallying up. What you're going to look for is once you see a high form, let me zoom in. Once you see a high form, you need 4 candles. Why 4 candles? You need to have 1 candle to the left, 1 candle in the center, the most highest one, then a lower candle to the right. That's a swing high, and then you got to see price go lower. When that happens, you start waiting for price to retrace back to equilibrium. Now, what is equilibrium? Equilibrium is a midway point of a price move. Okay, so we're measuring the high from this low. You take your fib, you draw it up to the low, and you drop it. Equilibrium is over here. Let me scrunch this up a little bit more. Okay, so we have this price leg up. So impulsive price swing goes higher. As soon as we get 3 candles, then and only then will we start watching for price to come down to the equilibrium price point. And that is basically the Fibonacci level 50%. Okay, we're looking for price to come down to that level. And as soon as it comes back to that level and we're on a daily chart, we go down into a lower time frame and we hunt buying opportunities. Now, I'm not teaching you buying entry signals, okay? I'm giving you context of how to discern when the market goes to discount and when it's at a premium. And we're not trading at premiums, okay? Well, I'll teach you how to use premiums the first video of next week, okay? So we're only focusing primarily on equilibrium versus discount. We have a price swing that moves from a low aggressively up. We don't do anything until we start seeing a down move, and it has to happen after 3 candles, basically making a swing high. Now, a swing high looks like this. Okay, you can see it has a high and a candle to the left that's lower and a candle to the right that's lower. That's a swing high. And then once that swing high forms, we're waiting for the 4th candle, okay, to start coming lower. In other words, we're looking for 4 candles to start turning around. When that happens, okay, it gives you, now you're allowed to start looking for the market to come down into equilibrium. That means the 50% level. Okay, once you're on a 50% level and you're in a higher time frame, and we start everything at a daily chart, at the daily chart, we know now that between the low here and the high here, the market now has gone back to equilibrium. So it's at fair value or at fair market value. If you get something at fair market value, obviously you're not paying a premium, but you're not really getting a discount either. But it's still a neutral to bullish condition. That means you're not buying at an inflated price. So this time period right here, the market is offering an opportunity to be long. I'm not going down to lower time frames today. I'm not going to teach you that today. Only thing I'm giving you right now is developing context around the daily institutional price levels that are arrived at on the daily chart. And all you're looking for is impulsive price swings first, letting price settle back down into equilibrium, and then we discern what we're going to do when we get to that level. As you can see, without going into lower time frames, the price does rally again. Where does it rally back up to? Its old institutional order flow reference point, which is an old high back here. So it goes right above that previous high. See that? Now the market trades off again and goes lower. So we have now a new range. We have to now put the Fibonacci on this high, keeping it off this same low. Now, why did I do that? Because this price low has not been violated. It only retraced down to here. It rallied up again. Then we wait for 3 candles. The high candle to the left, there's a lower one. To the right, there's a lower one. This is probably a Sunday, and even still, this is one here. Either way, you don't want to count Sundays, by the way. MT4 on Forex LTD does give you the Sunday candle, so you got to factor that out. Don't count Sunday's candle because it's a non-event. So that's probably going to end up becoming this candle here. Once you get the down candle here that the market has in fact turned, it's starting to go lower. Notice what's happening here. We're not rushing. We don't need to catch the high. Okay, it gives us all kinds of time to wait and plan and build an idea about what it is specifically we're going to do when price gets to equilibrium. Price drops down a little bit more, then it goes up. What do we do the whole time this is happening? Nothing. We're not doing anything. This is a higher time frame principle. Most of you are all begging for a higher time frame principle to trade with. This is the beginning building blocks to that. Okay, market trades lower, lower. What do we do here? Nothing. We're not doing anything here yet. Okay, nothing. Trading lower, 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 lower. All of a sudden, boom, it hits equilibrium over here. Now we can start studying price. We want to study price. On the lower time frames, we'll look for entries, but I'm not teaching you entry signals here. I'm giving you context. As soon as we get to equilibrium, we are now at fair market value, so the market is permitted to be bought. Okay, at the banking level, they will be able to buy at these levels because they're not at a premium-based market. The levels that are trading at this level here are at fair market value. Now, banks are just like anyone else. If you go to the grocery store and you see steaks for $10 of, I don't even know what they cost because my wife does all the shopping. If a steak costs $10 at the market and it drops down to $8.50 a steak, that's probably a discount. And it may not be that price, I don't know, but for the sake of analogy, we're using it. That means that we are now at a discount. Anything below equilibrium is now a discount market. When markets go below equilibrium, they do not spend much time below equilibrium, and there's usually a very dynamic price move away from that, especially if the context behind the marketplace is bullish. Looking at this framework we have here, we had an impulsive price swing here, a tiny little retracement, came back to equilibrium, rallied one more time, took out the high over here, and then sold off. Okay, went back down into equilibrium again and went to a discount below 50% of the impulse price swing. That is now at a discount. So the market on the banking perspective is that this now is at a discount. It is allowed to be bought. Now, you just don't go indiscriminately in there trying to buy it just because it goes back to 50% or less. That's not enough. You got to have more information. When we get to equilibrium, we know that we are at fair market value. It's a market that can be bought if we are bullish, but we can't buy it. We can't buy above this level up to here. Okay, that's the point of what I'm saying. The best buys come at equilibrium or less. Anything below equilibrium or the 50% level is viewed as a discount. Now, the wonderful thing about understanding this is when a market's at discount and its underlying basis is bullish, discount prices don't stay in the market very long. The market's going to want to run away from that really quick. Because this is a daily chart, this isn't that bad in terms of how much time it's spent down there below equilibrium. But you can see finally it explosively moved away from that and rallied up through what I asked you guys to do in the third tutorial, which was to, on your charts, mark out areas of where equal highs would be and where old highs would be. The market rallies from that price point and goes right back up and clears out these equal highs. When these equal highs are taken out, if you were a trader that only took a long in this area, and it don't have to be an exact science as far as where it was, we're just going to speak in general terms. If you went along somewhere in this small little consolidation before the expansion, okay, between buying at the 95 big figure roughly up to these equal highs, that's about 98.50. Yeah, about 98.50, and you bought around 95.50. So that's 300 pips move on a signal that would have formed. It took a little bit of while to come to fruition, but based on equilibrium and discounting, okay, you can frame the ideas in which the market should react. It should be viewed as a discount across the board, and if it is in fact bullish, the banks will dogpile on this and send the price higher, and it should be with quick dynamic price action. Understanding where it should be reaching for, above old highs, above equal highs, okay, above closing a range, okay, which we don't really have in here, but I'm just showing you just in one example here. Already the first one, it's 300 pips, okay? Then we have another price move all the way up here. There's no real retracements in here because watch, we have a high, equal, a little bit lower here, and then here's one here. If we would have measured the low to this high, it doesn't come down to 50%. It's nowhere near. I can eyeball that. You can probably do that too, but I probably might. Let's just do it because I'm probably going to have some of you folks that are from different countries having a hard time understanding my English, let alone Forex. If we would have measured just this impulsive price swing right here, notice that even though we had the candle here lower on the fourth one, it had an up close, but it was still lower. Nothing came back down to equilibrium. It stayed at a high price, and it just kept going higher and higher and higher and higher and higher. So if we go back to adding the fib to that initial price low here, and we stretch it because now we broke this high. We're going to keep drawing the fib up on swings that move up dynamically. So we have this big parent price swing. So now we're going to wait until price gets back down to equilibrium. When do we start waiting for that? When the market shows a swing high, which it does here. Then we start counting to the fourth candle where it drops. So the fourth candle has to move lower or be lower than the highest candle that makes the swing high. It's a very simple thing. And then from there, we just start waiting and we count down every time it goes down to a newer low, low, lower, low, lower, low. And finally, what's it hit right here? Equilibrium. That's that 50% mark. As soon as it does that, the market is at a fair market value so that it can be bought on the banking level. It cannot be bought until it gets to that level or below. They won't come in. They won't do it. It's not based on Fibonacci. I'm just showing you in terms of equilibrium between old highs and old lows. It's just a valuation marker. That's all it is. Okay, so the algo will kick into a buy mode in here, especially if they have orders at that level or just a little bit below it. And if they are there, you'll know it because the price will react immediately like it does here. It hits it one time. It doesn't have another candle touch it. This one gets close to it, but it still rallies away. Okay, so now watch what happens. We have another impulse swing here. Price moves away from an area where we expect it to rally. Why do we expect it to rally there? Because between this low and this high, price should be sensitive here on the upside, and it rallies. Now watch what happens. This is a big, big step. I'm going to keep this Fibonacci just like it is. I'm going to add another one right on the low that starts here, and it runs up here. See that? So between this low up to this high, why are we counting this swing? Why are we using this Fibonacci price swing, Michael, and not something else? Because this one showed reaction to want to move away from an area we would expect it to move. And now watch, we have a swing high. Here's a high, lower high, lower high, and this candle is lower than the one on the highest portion of the swing high. So now we start counting down until price gets to what? Equilibrium or less. The next candle doesn't do it. This candle does. It goes right down through equilibrium down into what we call optimal trade entry. So when we get below equilibrium, all this timing here, look how much time it gives you opportunities to get in at 62 to 70.5%, which is the optimal trade entry sweet spot. If you look at that, price gathers up more orders and rallies away aggressively. Watch what happens again. Now we have another reference point. This is where we expected price to react, and it did. It gives us another price leg. We pull it all the way up here. From this low to this high, we get a high, a low, a lower low on this one, and we're already below equilibrium. Look at the bizetted candle. We wick through it. I'm not going to talk about order blocks here as much as I want to right now. It's for some of you guys that do know order blocks. You probably already know what I'm talking about before I would say it. But in here, we expect price to be sensitive in here, okay, because we're below 50% or equilibrium. We're at a discount. Price should not spend much time there at all. It quickly rallies away, okay, and it comes back down. I could draw a fib on this low to this high. Matter of fact, let me just do it. After all, that's the context of what we're teaching here today, right? Pulling the fib on all these levels where there should be reaction. Okay, market rallies up. Here's the swing high. The next candle, the fourth candle's got to be lower. It does. It trades through equilibrium right into optimal trade entry. Does it stay there long? No. It rallies up, comes back. It doesn't break the high. Comes back one more time to equilibrium, and then aggressively moves away. And expands, and then finally it gives us a reversal. But nonetheless, that right there from buying in here to here, let's look at that in terms of range. $300 pips again. Okay, it's not every day setups, okay, but it's giving you significant setups. If we look at the moves that we called in here, using what I'm showing you, if you bought down in here, just to this level, here's 140 pips. To here, it's 272 pips. If you held on to it, it's 400 pips. This price move in here, price should be sensitive right here. I'll throw it in here. Order blocks right here. You'll learn about those. But the Fibonacci we just showed you, it's still there. And watch this. We had a price swing here that reacted off of a level that should be bullish. Here's our new price leg here. We have a high and a higher high. So we have a higher magnitude price swing that's going higher. We wait for the swing high to form. Down candles right here. Equilibrium's right here. Into the optimal trade entry, which is a discount. It's got to be below equilibrium. If the market is below equilibrium, we are in a discount market, and it should not go below the old low it forms. In other words, wherever the impulse price swing is, that low it starts from, it can't go below that. So think about what it's already given you. It's given you a framework to work within. Okay, I don't need to know exactly where I'm buying at. I just know a general area. I can fine-tune that down into lower time frames. When we do top-down analysis, I'll teach that. But for now, if we understand this is the low we draw our fib from, that a stop loss has to be below there on this time frame. So we can buy in this area here, put a stop loss down here, define the risk between that, and then how much of a risk to reward will we get based on how far it should reach up. Every time that price makes an impulse price swing higher, we just wait for it to come back down, and there's no rush. We just wait. It takes 3 candles. On the third candle, it can hit equilibrium and go below it, but we need to just simply wait for the swing high to form, and then you watch it drop down. Once it drops down, you know what you're going to be expecting. The price move should be explosive to the upside because the market goes back to a discount below equilibrium. It can be as sensitive at equilibrium, but here's what we're supposed to be focusing primarily on. You want high odds trades. You want high probability explosive price action moves in your favor. That happens when it goes below equilibrium because the market will go to a very suppressed levels. And when they go below equilibrium to a discount level, markets will not sustain discount prices very long if the underlying pinnings of the marketplace is bullish. So it gives you 2 things. It gives you a context to work within when you for buys, and it gives you also a relative strength study that's built in. It should be sensitive. It should be dynamic. Price action moves away from that equilibrium or less. More specifically, below equilibrium.